Now, the topics is today, as you see, the fiscal and monetary policy implementation in emerging market economies. And the first slide, as you see, the key points. By the way, there's a question there. I think Umutonabiza. I don't know how can I open his voice. I'm trying to give the microphone to that question, but even I try, I couldn't achieve to give the microphone. Is there anybody to control the session to give the microphone to an attendances, because I think he is trying to ask a question. Antonella, is there a possibility to give the microphone to the attendances? I think at the beginning of the session, he's trying to ask a question, but he couldn't achieve. Could we do this, Antonella? Anyway, I think, okay. Okay, it is unmute. Mutonavi Aiza, Lloyd Anna. You can ask your question. Hello. Hello, do you know?
Hello.
You raise your hand. Do you have a question? We are waiting you.
I have no question.
Okay. Please then, if you don't have a question, don't raise your hand, because I suppose that somebody have a question here and I'm trying to answer. And as I say, if the attendances have question, please collect your question until the end of the classes. Last 10 minutes, I will give the microphone to all attendances, okay?
Yes.
Let me share my screen again. Here it is. I'm opening my camera as well. The key topics here today, as you see in my screen, the pandemic, the COVID-19 crisis, represents a massive, unprecedented global economic and financial shock. First of all, you should understand that pandemic is not a direct demand or supply side driven basic crisis. It is really big crisis. So please don't compare the pandemic crisis with 2008 financial crisis, or let's say 1991 petroleum crisis or Gulf crisis. You can only compare the COVID crisis with Great Depression, that 1929 crisis. Is there anybody? I reflect my screen, but somebody dropped my screen. Please, any attendances, don't touch the screen, please. Because I'm reflecting my screen. Then if somebody, any attendances touch the screen, this share point and share screen is dropping. Okay. Please try to listen the session patiently. The pandemic, as I said, cannot be compared last 30 years or 50 years crisis. You can only compare the pandemic to Great Depression in 1929. Okay, it is really big shock. The pandemic represents a massive, unprecedented global economic and financial shock that is having a deep impact on emerging market and developing economies, with many facing acute strains and large-scale capital outflow. And central banks during this crisis play a critical role in cushioning economic and financial impacts. Given the multi-phased nature of the shock, there is a strong rationale for deploying multiple tools. For emerging market and developing economies, with credible policy framework, the advanced efforts that were advanced economies, exchange rate adjustments, and additional monetary easing will be appropriate for emerging market with flexible exchange rate, credible monetary policy regime, and low inflation. I will try to explain these later. No worry, just we are trying to cover the key points here in the slides. In some emerging market economies with weak policy credibility, the scope for loosening will be limited, given the risk of disorderly exchange rate adjustments, surging inflation, and financial stability implementation. And macroprudential policies and counter-fiscal monitors can play important complementary roles and help safeguard financial stability and enhance the effectiveness of monetary policy. Let me first try to explain what this sentence is trying to say, especially here. The central banks play a critical role. Why? Because central banks is the highest monetary authority, who is managing the economy, who is implementing the monetary policy, who can control the interest rate, and then adjust the prices levels. For emerging market and developing economies with credible policy framework, the advice echoes for advanced economy. Exchange rate adjustment, additional monetary easing will be appropriate with flexible exchange rate, credible monetary policy, and low inflation. What we here trying to say, the credible monetary policy. This point is important. Credible policy is this. If you are in a country, it is emerging market, it is rich. Let's say Saudi Arabia. It is not an advanced economy. It is an emerging market economy, and their purchasing power is really good because they are oil-rich country. But we know that there is a kingdom there. Then one day, the kingdom can change the power of the monetary policy, the head of the central bank governor directly. And if the investor don't know what will happen in the next day in these countries policies are not credible. Okay, meaning that one can decide everything, one can change everything, one can control everything. Independent monetary policy, independent central banking, independent decision-making process cannot be applied in this type of country. Sometimes even the army make a coup d'etat, control the economy, control the government, and decide everything. So in this type of country, we don't have the credible policy. To have credible policy, central bank should be independent. Central bank governor should be independent. Every investor and consumer should know that what will happen next month and next week. If you don't know what will happen tomorrow in this country, the policies are not credible. It can be changed every second. Okay, credible policy is important. As you see here, it is also trying to explain this reality. In some emerging markets with weak policy credibility, what does this mean? Policy credibility is weak. One can change and decide everything. And tomorrow, everything will be different in this country. For instance, even let's say Biden win the voting, or let's say Trump in the voting. The institution will not be changed in the United States. Whatever the president, who is the president, it is not important. The institution can decide everything because there is an institutional framework in this country. But let's say the government changes South Africa or Brazil. Everything is changing. So in these countries, the policy credibility is weak. Okay, it is not credible. Policy can change according to the president, not according to the decision or the institution. Policy change according to who is governor, who is president, who decides. But in Germany, for instance, whoever the president, whoever the governor is not important. The process of the decision making is always safe. Okay, cannot be changed. And macroprudential policy, these are really important policies, especially after the 2008 crisis. Why I'm saying this? Because lots of people say that the implementation of the monetary policy is enough to maintain the price stability. But this is not true. The implementation of monetary and fiscal policies successively needs some macroprudential policy help as well. For that reason, What we mean by macroprudential policy? Macroprudential policies are some tools. They are complementing monetary and fiscal policies. Let me say one of the macroprudential policy. Let's say Anna wants to buy a house. Okay. Anna has approximately 200,000 euro. Okay. And Anna wants to buy a 2 million euro houses, let's say in Germany. If the house is 2,000 million, no, not 2,000 million, just the house is 2 million euro. Let's say $2 million, not euro, $2 million. And Anna has 200,000. So Anna needs $1.8 million borrowing right from the bank, because the total cost is 2 million and I have only 200,000. So I will buy a mortgage credit from the bank. But if everybody buy this type of credit from the bank, let's say Samuel also buy, Abdul Lamin also buy, then there will be huge mortgage credit in the market, right? And everybody buy the new houses. If Anna, Samuel, or Abdul Lamin at the same time buy a new houses, then the house prices will go up, right? Everybody buying a new houses. If I don't want to increase in the house prices, but if I also don't want to increase the interest rate, I can do this. Loan to value ratio. What does this mean? Loan to value ratio meaning that loan is the credit you can apply for the bank, and value is the house value. Let's say the house value is 2 million. And the monetary authority is saying that loan to value ratio is, let's say, 60% today, meaning that 60% loan to value. What is value? $2 million. 60% meaning that $2 million, 60%. What is it? 1.2 million. So Anna can only go to the bank to buy $1.2 million mortgage. She cannot buy 1.5 million. I'm restricting it. Loan to value ratio. I am deciding. I'm not increasing the interest rate, but I am managing and deciding how much money can the Anna borrow for a houses. Okay, this is the loan to value ratio. It is not a change of the interest rate, but it is directly change of the loan to value decision making process. In this style, I'm directly can decide what is happening here and what can I decide in the long run in this type of economies. So let me explain this slide as well. Here, as you see, in the overview, COVID-19 pandemic and related adverse confidence effects are having severe negative impacts on global economic activity. It is really decreasing the prices, consumers, households, restaurants, everything. Negative impact on global economic output. An imminent threat to the financial stability. By the way, price stability is inflation, but financial stability is the other side. We will cover the financial stability in the next section. It is a deep topic. Emerging markets are facing a sharp sudden stop in capital inflows with attendant high risk of currency crisis. The impact of shock is complex and involves several elements. And domestic health crisis. We have lots of health and death in the COVID. And supply impact. Remember that normally from Shanghai to the California or Los Angeles, one ship reached in 20 days. But during the COVID crisis, it reached in 3 months. So if Samuel wanna buy a Nike or let's say Apple, normally Apple distributed to the Samuel the Apple products in 20 days. But during the COVID crisis, it come in 3 months. It's the supply side, supply chain problem. So everything is postponed and prices is going up because everybody wants to buy, but the products are not delivering to the consumers because it is not coming. No ships, no money, no people in the sea because there is a COVID. Demand and terms of trade impacts, as I say, lots of problems. You have money, you have enough capability, but whatever you want, they even cannot distribute the services and goods to you, whatever they can do. An impact on financial condition. As you know, even if you want to buy a house, even if you buy a car, you cannot even go to the banks and apply for a credit because there is a direct closing in the economy, nobody on the street. So these are severe impacts on global economic condition. And let me explain those type of impacts in charts and slides. Please try to focus on this chart. First, try to understand. Here, as you see, in emerging market economies, monetary policy tightened while fiscal policy remained expansive. What does this mean? After the COVID crisis, when we started the quantitative easing and when the inflation reached the targeted level, then developed market economies started to increase the interest rate and started to implement the quantitative tapering process. During this process, as you see, emerging market economies also tightened their monetary policy, meaning that they are also implement the quantitative tapering. They increase the interest rate, they take money back, give the government bonds and treasury bills to the economy again, meaning that tighten monetary policy. But in reverse, the fiscal policy side still expansionary. What does this mean? This means that while you are increasing the interest rate, while you are restricting everything in the economy, while you are trying to persuade people not to buy new things because it is increasing the inflation, on the other side, governments increase their really government infrastructure and expenditure. Governments always expansionary during this process. Why? Especially for the 2024, almost half of the world population is a voting process disease. So if you are a government and if you want to re-elect in this economy, you should purchase, you should expenditure, you should make infrastructure, you should how can I say, you should change the traffic lights again, you should change the ways because you want to persuade the people to re-elect you again. So in this environment, you are increasing your government expenditure. And reverse to the monetary policy, the fiscal policy is still expansion. And as you see in the left-hand side in chart A, this is, as you see, change in policy rate, okay, here. And here, change in fiscal balance. These are percentage of the GDP. And as you see here, in 2020, the change in policy rate, as you see, negative, right? Decreasing the interest rate. And fiscal balance during this year, as you see here, fiscal balance in 2020, the fiscal balance is here as well. But now in 2022, as you see, the change in policy rate is really high and government fiscal balance, the budget deficit is really high as well, as you see here, okay? For instance, the government fiscal balance here, huge deficit, and policy rate is still high, meaning that policy rate high, it is a tightened, it is a contractionary monetary policy. And in reverse, fiscal balance, budget deficit also high, meaning that government also increasing their expenditure, expansionary fiscal policy and contractionary monetary policy during this time in emerging market economies. And when you look at 2019, 20 and 22, and these numbers again, percentage of GDP and cyclically adjusted primer balance. By the way, when you try to understand what we mean by fiscal balance and what we mean by the primary balance, These are just the technical difference. Primary balance is this. The government revenue minus government expenditure is my primary balance. Okay, this is my basic primary balance. But if I also add interest payment to the primary balance, then I will reach the overall fiscal balance. Okay, primary balance is just revenue minus expenditure. But if I also add the interest payment for my borrowing, this is the overall fiscal balance. As you see here, in 2019, the fiscal balance is almost near the zero. But as you see here, during the 2020, fiscal balance and primary balance is really giving the deficit, approximately 3%. And now it is trying to recover, but still the budget deficit is higher than 2019. Look at these points. Look at these points. From 2019, we are still have a higher budget deficit. But when we compare 2 years ago, budget deficit is trying to recover. And when I look at the chart C, I'm seeing here that the fiscal balance and cyclically adjusted primary balance. The dots are primary balance, and the normal dashed line, normal line, is the fiscal balance overall the economy. And I'm seeing here, during the COVID process, my balance, even in primary, even adjusted, even fiscal balance, it's a huge deficit because even the United States sent 1,000 cash check to every household to pay and to pay more, to buy more, to buy the goods and services because nobody going out, they don't have money. And governments in the United States send basic cash check for 1,000. And this money is not coming under the soil. This money is coming from the government. If government give this money to you, there will be a huge budget deficit in these economies, right? And here, as you see, during the COVID crisis, we have huge budget deficit. And then to finance those deficits, then government started to increase the tax rate because I really give huge money during this period. Now I need to finance those deficits. Now I'm increasing the tax rate. And here, from approximately 8%, now the budget deficit is around 3%, but still high when we compare these deficits from the pre-COVID period, around 1% budget deficit per COVID. Okay. And loose fiscal policy, when we look at these charts, the loose fiscal policy around these economies, I'm seeing that loose fiscal policy raises the risk premium and put pressure on the exchange. What happens if we feel the pressure on the exchange rate in this type of economies? Let's say, I don't know where the people are from here, but if I guess from the name, Anna should be coming from a Slavic country. Is it true? I don't know. Anyway, I will just say this. Let's say Anna is coming from a Slavic country. Let's say Serbia, Ukraine, or Russia. I don't know. But all these, I couldn't hear. You can write from the chat, Anna. Okay, let me see from, yeah, it is here. Yes, Macedonia. Okay. It is near the Turkey. I'm in Istanbul now. We are both emerging market economies, right? And let's say Anna, I'm giving this example from Anna, but you can expand this example for Abdullah or somewhere. This will be the same. Okay, the logic is same for this type of examples. Anna is from Macedonia, and Anna wants to buy a Mercedes. Who is producing the Mercedes? The Germany, right? And let's say, I don't know the exact currency in Macedonia, but it is near the Greece and near the Albania. And let's say today there is a domestic currency because it's not in the European Union and they have not using the euro as well in Macedonia. Yes, maybe partial they are using, but they have their own currency, right? Let's say it is like lira. And today, let's say 1 euro is 5 Macedonian lira. Okay, I'm giving example. And let's say Anna buying one Mercedes for 15,000 euro. So what is the 15,000 euro in terms of Macedonian lira? If 1 euro is 5 Macedonian lira, 15,000 is 75,000 Macedonian lira, right? Anna buying one Mercedes in terms of Macedonian currency for 75. Okay, and the price of the Mercedes for this. And let's say Macedonian government and central bank make something wrong in the economy and their Macedonian currency started to depreciate, losing power in terms of euro. And let's say now 1 euro is 8 Macedonian lira. Okay, now 8 Macedonian. Now what will happen to the Mercedes prices? If 1 euro is 8 Macedonian lira, 15,000 euro is 120,000 Macedonian lira. What happened in the previous example? 75, now 120. So Anna will pay 45,000 more because of the wrong exchange rate policy. And the Mercedes is now really expensive for Anna. And exchange rate directly impact the inflation and prices in the economy. Okay, you should understand how the imported products, because you are not producing Mercedes, you are not producing the Apple. In Turkey, I am not producing the BMW, I am not producing Audi, I am not producing Microsoft. So if I'm buying these type of products, I am first buy the dollar from the market, then I'm importing these products from the United States or Germany. And if the exchange rate increasing, my currency is depreciating, meaning that prices will be higher and inflation. Okay, so inflation and exchange rate really connected to each other in the emerging markets. You should keep this in mind. Okay, let me check from the other graphs in my PC and laptop again. Here it is. Yes. And now I can directly say this. As you see in the title, loose fiscal policy raises the risk premium. Why? If the ANA and euro in the Macedonian economy, if the Samuel want to buy something and if the Samuel government makes something wrong, nobody in the developed markets want to give the credit for the Macedonia or Kenya or let's say the South Africa. They will not give the credit because they know that the governments make something wrong in this economy and there is a high risk for these type of economies to not get your money back. So risk premium is increasing. As you see, loose fiscal policy raises the risk premium and put pressure on the exchange rate again. Because if the risk is higher, now the currency is depreciating again. And as you see here from the charts, on the left-hand side, I'm seeing response of 5-year CDS spreads to one standard deviation of the primary deficit. Do you know what is CDS? CDS is showing how your country is risky. Credit default swap, meaning that Macedonia or Kenya or South Africa cannot pay their borrowing, their money back to the lending countries. Let's say they borrow from the Germany, they borrow from the United States, and there is a high probability in this country not pay those debts again. So the CDS showing how risky you are. Credit default swap. Okay, you cannot pay your credit and you can go into default. This is showing the probability. So on the left-hand side, if the credit default swap increasing, now you will borrow with higher cost in international economy, because nobody will give money with cheaper cost to you, because you have a probability of default. You cannot pay the money. So you should give higher interest rate for me. And if you pay higher interest rate, your budget deficit will be increased, because you borrow the money, you will also pay the interest for that, right? So your budget deficit will increase. And here, risk weakens the exchange rate as well. If there is a risk, your country's currency depreciate again. Nobody will give the money to the weaker country whose currency can be depreciated every day, like the Turkey. From 5 to the 30 we are today. In 5 years, from 5, now $1 is 32 Turkish lira. Huge depreciation. Nobody gives the money for this type of economies. And here, as you see, the emerging market economies not fully conquered the original sin. Original sin is this. Ana coming from the Macedonia. Let's say Samuel, I don't know, or Abdullamini, but they are coming from the African countries. I am just giving example. And because our countries, let me say, I'm coming from the Turkey as well. And from the United States, when they trying to give the money to our country, Macedonia cannot borrow money from their own currency. Turks, we cannot go to the America and give the money borrowing in my own currency. Or Samuel government cannot say, give the money in Kenya currency, because they know that you will not pay your money and I will not get the risk, I will not take the risk of the currency. Also, for that reason, these countries cannot borrow in their own currency. This is the originals. Australia go to the international market and borrow the money always in Australian dollar. Germany go to the international market, always borrow money from the euro. But Turks cannot go to the international market and buy the money in Turkish lira. This is the original thing. Okay? Because nobody believes that Turks can pay their debt in their own currency easily. I don't want to get the currency risk in this economy. And here on the left-hand side, as you see, fiscal deficit and the fiscal balance. This is a linear regression. This is y 2.5 and r squared. This is the goodness of it in econometrics. This is statistics. Okay, this is a model. And fund flow and fiscal balance. As you see, there is a huge capital outflow in these countries, and the fiscal balance is really volatile in this type of economies. For that reason, they don't want to take the risk of the currency and fiscal balance in these economies. And this higher debt raises the probability of the reversal, because you have really huge debt, and even in a sudden risk, lots of capital outflow from your country. All portfolio going to outflow and turning their own countries, not to stay in your country to invest more. And the tight financial condition, please look at this one as well. Tight financial condition compound financial risk of fiscal policy. Look at the left-hand side in graph A. The financial conditions are tight because nobody wants to give the huge credit in this type of economies. Financial condition is tight, but fiscal policy is expansion, because banks are not giving the credit, because they know that in the tight monetary policy, if the interest rate is high, I will apply the financial condition in tighter monetary policy stance. And here, please look at the chart B. In chart B, the United States dollar appreciation correlated with higher sovereign risk premium. If the United States dollar appreciate, meaning that my country, my currencies depreciate. And if my country's currency depreciate, my risk is increasing. And this is bringing a sovereign risk premium for my government. For instance, let's say 10 years ago, the Turkish Treasury 10-year bond in the United States are just 2%, but today it is 8% United States dollar. Why? Because now Turkey is more risky from the international investment perspective. And normally you are borrowing in 2% in government bonds in United States, but today you are borrowing in 8%. Those 6% is your risk premium. Okay, those 6% from 2 to 8 is your risk premium in the international market. And as you see in this chart, we have lots of global inflationary pressure. The black line is the United States, the purple line is the Eurozone, and the UK is the light blue. As you see during the COVID process, please look at this side. There's a huge increase because of the quantitative easing. And then from here to here, there's a sharp decline because all these economies, especially the advanced economies, I am giving the example from these advanced economies because they are the leading indicators from the global monetary and fiscal policy implementation. And they directly implement these policies in tight side, then the quantitative tapering, then inflation started to decrease. And the market-based inflation, this is 5-year inflation spread, meaning that how much interest rate I need to compensate my loss during 5 years. Because of inflation, my money purchasing power decreased, right? So to compensate those loss, how much interest rate I need. And here, as you see, inflation compensation is around 3% today. So inflation expectation management is good. The Powell managing the economy with forward guidance very well. And as you see, the market is expecting on the left-hand side, please look at the line here. The US is black, purple is Eurozone again, light blue is UK, and now the green is Japan. Look at this and look at this. You will see something wrong. As you see, in US, Eurozone, and the UK, market expect that interest rate will decrease because inflation will decrease. I don't need to higher interest rate to compensate my loss because if the inflation decrease, I will lose less money. So interest rate can be decreased. But for the Japan, because they always, during the last 20 years, always they have deflation. So just this year, they achieved to produce a positive inflation at last positive inflation, the Japan after 20 years. And for that reason, there is an inflation. The interest rate will be high for the Japan. Japan is outlier. And here, as you see, we have global central banks balance sheet. And these are the asset purchase program during the COVID. Look at it here. The COVID start period is 15 trillion in asset purchase program. And when the COVID ends, I have 10 trillion more asset in central bank, meaning that I bought lots of securities from government and treasury and during the quantitative easing. Then after this, I started to quantitative tapering. I'm giving your old securities back, give my money, dollar, euro, Japanese yen back to the central bank. I'm selling all these assets to you because these are in pre-COVID period, these are belongs to you. Take your securities back, give my money back. And now it is converging to 20 trillion, but still higher than the 15, which is pre-COVID period. Today, 5 trillion higher asset in central bank balance sheet. And the global fiscal policy side, as you see again, the United States, Eurozone, and the UK, public sector investment. And as you see, during the COVID, here we have global financial crisis in 2008, and here we have COVID crisis. And today, as you see, public sector still expansion. They are making huge investment. And budget balance, as you see, global financial crisis, budget deficit. As you see here during the COVID, I'm saying the governments distributed the money to the household, giving the pay cash check. Please purchase and buy something. I'm sending the money to you without no return, without no cost. I'm sending a cash check. So this cash check does not coming from the God, right? They are coming from the government budget. So if you distributed this money, you will give a deficit. Here you give the deficit, then you increase the tax rate, and then you recover. But pre-COVID period is around 3%, but you are still budget deficit around 5-6%. budget deficit still higher than the pre-COVID period. So governments should go to the fiscal consolidation to make their budget resilient as it is like the pre-COVID period. Fiscal consolidation is a must for governments all around the world because they give huge deficit during the COVID crisis. And to bring the budget deficit around 3% again, you need huge fiscal consolidation, increase in tax rate, and decrease in the government expenditure. As you see, the global government debt is a huge shrink here. Around 80%, now 120%, meaning that 50% increase in overall government debt. This is a huge money. You cannot imagine. Trillion dollar here. So we should also need the fiscal consolidation here. And government interest payment. What does this mean? I'm buying the debt. I will pay back this debt. But during this period until the maturity, I will also pay the interest on it. And if the interest rate is higher, my interest payment on my debt will be higher as well, right? So the interest payment on government debt is around 4%. And if you think how much government debt the United States, and each year they will pay just 4% for the interest rate, this is a huge money. Trust me, you cannot imagine how much money is this. Even 4% of it is a huge money. And last two slides is coming from the United States Federal Reserve policy. It is, please look at this. This is the interest rate, policy rate, central bank rate. During the global financial crisis, it is zero lower bound. During the COVID crisis, it is zero lower bound. Then after the crisis, the interest rate is increasing, as you see here. But now, if you look at the dot line and dash line in the long run projection, the interest rate will be same with the inflation target as you see here. Inflation is targeted at 2%, and the policy rate will be in the long run as 2%. Okay, there will be no volatility, there will be no unexpected shock in the market. And this is for the European Central Bank side. As you see here, the European Central Bank policy rate rise approximately 4% from the negative side to the positive 4%. And then with the decrease in the inflation, they are starting to decrease as of 2024, their policy rate, but until the 2028, there will be a huge inflation in the Eurozone again, and it will increase. And this is the European 10-year government bond spreads over Germany. What does this mean? If the Spain, Portugal, Macedonia, Albania, Italy, Greeks, 10-year bonds spread from the Germany, meaning that the risk is increasing in this country. If the spread is exactly same with Germany, meaning that there is no risk in this country. But if the spread is increasing, meaning that you should pay more than the German, meaning that you should be higher risk more than the German. Okay, you should always keep this in mind. If the spread is increasing like in crisis period, there's a crisis in this country.